Your lender smiled when you signed, and you had no idea what you just agreed to. Let's rewind. Because this didn't start with your mortgage. It started with a number nobody explained to you. A number buried in the fine print. A number that looked completely harmless on the surface, until it wasn't. And by the time most people figure it out, they've already paid it. For years. Sometimes decades. Hi, I'm Anna Hart. I focus on one thing, understanding how money really works. Because clarity is rare, and confusion is expensive. Back in the early 2000s, buying a home felt like the most responsible thing a person could do. Interest rates were low. Banks were generous. Everybody was doing it. Your parents told you renting was throwing money away. Your coworkers were upgrading to bigger houses. Financial advisors called it building equity. The whole culture around home ownership was built on one simple message. This is how smart people grow wealth. So you did what everyone else did. You walked into a bank, sat across from someone in a nice suit, filled out a stack of forms, and signed your name 37 times on a document you had maybe 2 hours to read. You trusted the process. You trusted the institution. You trusted that someone would have flagged anything truly important. And everyone believed that was the smart move. That's where things started to go wrong. Because there's a part of that document most people never question. It's not the interest rate. It's not the down payment. It's not even the loan term, though that matters more than most people realize. It's something called the amortization schedule, a table in the back of your loan documents that shows exactly how each payment is divided between interest and principal, month by month, for the entire life of the loan. And if nobody ever walked you through it, really walked you through it with a calculator and a pen, then you're probably still sitting on a trap you don't even know is there. But here's the part nobody tells you. On a standard 30-year mortgage, your very first payment is almost entirely interest. Not mostly principal. Almost entirely interest. So when you hand over that check on month 1, let's say it's $1,800, around $1,500 of it goes straight to the bank as profit. You're only paying down about $300 of what you actually owe. Month 2? Almost identical split. Month 6? Barely any different. Month 12? Still almost identical. You've handed over $21,600 across the course of a full year. Your loan balance has moved by maybe $3,600. That's it. You've been writing checks every single month, on time, and the mountain has barely shifted. Sounds manageable, right? It's not. Because here's the number nobody shows you on the day you sign. Over the full life of a $300,000 mortgage at 6.5% interest, you will pay back somewhere in the range of $682,000. That is not a typo. You borrowed $300,000 and you hand over $682,000. The bank collects $382,000 in interest alone, more than the entire original loan, nearly double what you asked for. And that's if everything goes perfectly. No refinancing, no missed payments, no job loss, no divorce, no emergency that forces you to skip a month and restart. Just clean, consistent payments for 30 straight years. And this is where it gets dangerous. Because most people don't stay in their homes for 30 years. The average American moves every 5 to 7 years, which means most people sell, take whatever equity they think they've built up, and roll it straight into the next house and the next mortgage, starting the amortization clock over from scratch. Back to month 1, back to paying almost entirely interest, back to barely moving the actual loan balance. They repeat this cycle 2, 3, sometimes 4 times over the course of their adult life. And each time, they think they're building wealth. Each time the house is a little bigger, the neighborhood a little nicer, the down payment a little larger. It feels like progress. But financially, what they're actually doing is resetting. Every single time. Handing the bank a fresh batch of early-stage interest payments, right when those payments are most profitable for the lender and least beneficial for the borrower. Nobody noticed it at the time. Or maybe they did, and just didn't say anything loud enough. Now here's where the system starts to show its cracks. The mortgage industry isn't designed to help you pay off debt quickly. It's designed to maximize the total interest you pay over time. The 30-year term isn't an accident or a convenience. It exists because it generates dramatically more profit than a shorter loan. A 15-year mortgage on the exact same loan at the exact same rate would cost you sometimes $150,000 to $200,000 less in total interest over the life of the loan. Your monthly payment would be higher, yes, but your lifetime cost would be radically lower. The bank knows this. They also know that most buyers sitting across the desk, exhausted from months of house hunting, emotionally attached to a property, will choose the option with the lower monthly number without stopping to do the 30-year math. So the 30-year gets presented as the default, the sensible choice, the affordable option, the one that quietly costs you the most. This is where the system breaks, because there are also tools most borrowers never hear about. Things like mortgage recasting, biweekly payment schedules, deliberate principal prepayment. These aren't secret strategies. They're not illegal workarounds. They're just options that rarely get mentioned at closing because your lender has no financial incentive to bring them up. Paying even one extra mortgage payment per year, just one, can cut years off a 30-year loan and save you tens of thousands of dollars in interest. You don't need to refinance. You don't need a better rate. You just need to understand where in the schedule your extra payment actually has an impact and act on it early while it still matters. But here's the thing. The trap isn't dishonesty. That's what makes it so hard to see. Everything in your mortgage document is technically disclosed. The amortization table is in there. The total repayment figure is in there. You were handed all of the information. It just wasn't handed to you in a way that made it feel real or urgent or worth stopping the whole closing process to interrogate. It was buried in 40 pages of legal language on one of the most emotionally overwhelming days of your financial life, when you were excited, when you were tired, when everyone in that room, the agent, the lender, the title company, was quietly aligned around one outcome, getting to the signature page. And that alignment is by design. The people who actually build generational wealth through real estate aren't doing it by following the default path. They're the ones who run the real numbers before they ever sit down at a closing table, who look at total cost over the loan term, not just monthly payment, who make targeted lump sum payments against principal in the first 5 to 7 years, when those payments shave the most off future interest, who understand that getting to a 50-50 split between principal and interest isn't the end of the journey. It's the turning point. The moment the math finally starts working in your direction instead of the bank's. That shift doesn't happen automatically. It happens because someone showed you the schedule and said, "This is what you're actually agreeing to." Most people never get shown. So they sign. They make their payments. They feel responsible. They tell themselves they're building equity every single month because that's the story homeownership is supposed to tell. And technically, they are. Just not at the rate they imagine. Not in the early years. Not during the exact window when it matters most. By the time the equity is compounding meaningfully, they've already sold, already moved, already handed a fresh $1,500 to a new bank on month 1 of a brand new loan. The trap isn't the mortgage. The mortgage is a tool. The trap is signing without understanding the shape of what you agreed to.